What is going on, everybody? Dave here, Hidden Free Investing. Welcome back to another video. In this video, I'm gonna go over Divo and just give you my thoughts on Divo because I think Divo is one of the best ETFs out there that could technically probably replace an individual stock dividend portfolio, and you're gonna get a little bit more dividend yield out of it, and you probably get a little bit more growth, maybe possibly too. But anyways, let's go ahead and talk about Divo and how this could possibly replace your dividend portfolio. So let's go ahead and get started. Okay, the first thing we're gonna look at here is we're gonna look at my dividend portfolio, because obviously there's an evolution change and all that stuff in my dividend portfolio I wanna kinda go over and then talk about the reason why I even have Divo to begin with. So I do have Divo in my dividend portfolio, which we'll go to current portfolio here. And then this is all the individual positions here. So I used to have a lot more positions. 2020, I think I got up to like 37, 35, 37, something like that at one point. So here is all the individual positions at this time. I got a CHD up there. Shout out to anybody that watched last week's video. So yeah, there's all the individual positions, and then down at the bottom here, we got a bunch of income ETFs. And then there's Divo right there. So right now there's what, $53,000 in Divo, and that's just in one account. And I've done a video a few weeks ago talking about building those positions out. So if we look here, I have intentions of building Divo out to about $175,000 relatively soon. Probably in the next few months or so, it should come up to about $175,000, definitely within the next 6 months. So that's a pretty substantial increase from the $50-something thousand that's in there right now. Okay, so let's also talk about, let me go back here to the dividend portfolio. Okay, so I did have a bunch of different individual positions in here last year. I took advantage of the market decline and all that stuff, and my whole intention was build the dividend portfolio up. Every time a position got above 100 shares, I started selling covered calls against it. And then I kind of ran into an issue where a lot of the stocks, they're probably not even really in here anymore. A lot of stocks that were in here, let's just say Colgate, for example, you just really couldn't make anything against, with a cover call with that, Procter & Gamble's probably another one there that you just really couldn't get paid much, even I have 100 shares. I don't have 100 shares now, but all these stocks were a lot larger. And the stocks that I really could make some pretty good cover call money on is something like AbbVie, something like Realty Income, Johnson & Johnson, JP Morgan, Apple, Microsoft, for example. Those are some pretty good ones to sell some covered calls against. Home Depot's they've actually not bad either, although it would take quite a bit of capital to have 100 shares of that. So just a lot of stocks in here you just really couldn't make any money selling covered calls against, unless you wanted to go with at the money, and then there you are, kind of locking in substantial gain if your stuff gets called away. Of course, you could play the game of just keep rolling up, but I didn't want to, have to play that game if at all possible. So that's where I did that for several months. Basically selling covered calls against a bunch of stuff that had 100 shares. It was making some decent money, and then things were just kind of went on a major run, and it was really tough because things would start challenging your strike price. And that is when I said, okay, this is just too much work, too much of a hassle. Plus, there's a lot of stocks in my dividend portfolio that I could not make any money on. So the way I look at it is kind of wasted capital. Yeah, it's invested in, let's say Verizon, for example, but you just couldn't really make any money off of it on covered calls. So it's kind of a wasted capital sitting there. The stock it's still invested in a stock. It's still capital appreciate and all that, but I wanted to make extra capital off of off of the covered call. So that's when I went into VYM, started selling out of some individual positions, and started building up Vanguard VYM. And eventually the VYM got up to several 100 shares, 800,000 shares or something like that. And I started selling covered calls against VYM. Now, VYM only had monthlies, and it was kind of tough to get above your strike where it's not going to run past it and cause you to have to get called away on 800 shares or something like that, or 1,000 shares, or how many ever shares I had at the time. And at the time, there was about a $17,000 gain or something like that in BYM, and I didn't want to realize that, right? So I don't want it to run past my strike, get called away, realize that $17,000 before it's long-term capital gains. And there's a couple times there where it got really close. I got lucky. It didn't breach the strike. And then, I ended up selling, another one out, I think 60 days or something like that, to get a little bit higher up in strike. And, come to find out, it still blew past it anyway. And not by a lot. You still give it a good 5% up move or something like that in 60 days. Well, guess what? We're in a bull market, at least back when I was doing that, and things just went on a run, and it challenged my strike many times. And there's a time I had to buy it back and took, I think it was like a $700 loss or something like that, to buy them back and then sell it out further. So, which is technically basically a roll. So that brings us to where I'm at now, okay? So I've been getting out of VYM over the last several weeks, and by this time next month, I should be completely out of VYM. So there's still $26,000 to get out of there, and still about $5,500 of realized profits that I'll be realizing, which will all be long-term capital gains by then. So every single day, some more shares hit long-term capital gains, and then I just take them out every day. And right now, that capital is going into QYLD just because it was down, and I wanted to try to build that position up. But a lot of the new capital, which I'll be getting probably next week, well, a lot of it will be going into DIVO, and probably some going into JEPI, some going to QYLD, and some going into XYLD. So. All right, so I sold out. I was starting to sell out of VYM because that, obviously didn't work how I thought it was going to work. In a major bull run like we are right now, yeah, sure, if the market trades sideways for 6 months or a year, I could make pretty good money off of selling cover calls against VYM. But it just wasn't working how I thought it was going to work. Now, that's kind of a good thing in a way, because that just means that the stock or the VYM, blew past my strike, which means it was capital gains or capital appreciation, which is a good thing. So that brings us to DIVO. Okay, now DIVO is essentially doing the same thing. Okay, so think of DIVO as a dividend ETF, because that's essentially what it is. And they have roughly about, I think, 23 holdings in there, mostly large cap. I think it's all large cap stocks. Here is DIVO's holdings right here. So they are about 23 holdings in there at this time. It is a managed ETF. So they could bring stuff in, they could bring stuff out, and they're going to go by what's opportunistic at the time. And this is the 23 holdings that they have. And then they actually have some covered calls on right now. So, being a managed ETF, I think it's a 0.55 expense ratio, so it's pretty low. It's pretty reasonable for a managed ETF. And these are quality positions. Look at these positions here. United Healthcare, Microsoft, Apple. We got McDonald's. We got McDonald's. We got Johnson & Johnson. We got, Chevron, Visa, Honeywell. It's decent, right? Goldman Sachs. We got Newmont Corp. We got 3M, Caterpillar, JP Morgan, Home Depot, Walmart, Procter & Gamble, Medtronic. Great healthcare stock there. Intercontinental Exchange. We got Duke, CSX. We got Verizon, Nakedy, and we got Dow. So those are some, really great stocks there that you would probably have in your dividend portfolio. And I have a lot of those still in my dividend portfolio, even though I'm not running any cover calls. And, somebody's even said, why don't I just sell all those off and stick them all in DIVO? And that could be something I do down the road. I don't really know yet. But so these are really great stocks that they hold in their dividend portfolio or in this ETF, and then what they do is opportunistically is sell covered calls against certain positions given where certain positions are. So for example, right now, it looks like they have some Caterpillar calls on, they have some Microsoft calls on. So if we just go look at Caterpillar's been on a little bit of a decline over the last few weeks or so, right? So that's the reason why they're probably sold some covered calls against the position. So if we go back here, it looks like they have 1,000 covered calls on, okay? So that means what? You times that by 100 because each contract is 100 shares. So they have at least over 100,000 shares, and we look up here, they have 127,000 shares of Caterpillar. That brings in the current market value at it anyway. I don't know what they actually sold them at, but the current value of that is $207,000. That brings us down here to Microsoft. We got a 297.50 there. We got 1,000 of those on as well. That brought in $327,000. Let's look at Microsoft here, 297.50. So we got Microsoft and 297.50. So that they've pretty much sold that one probably right at the money. I don't know when they put those on. Let's see if it tells us when they put those on. That expires, when does that expire? November 1st is, it looks like it expires. So I don't know when they actually put that on. I'd have to, we have watch this every single day. I think this is as of the 22nd. So I don't know when they put those on. So looking back here at the chart, I don't know where they sold it. They could have sold it when it was down here. And at this point, it may have even run past a strike. Actually, it did run past a strike. So they missed out, but they could have, anticipating the stock actually going down lower, which could happen. It did already close the gap, and it definitely could happen. It could be because of the market, and market looks a little weak right now, especially since you got the Fed. You look at this debt ceiling, and then you got the funding of the government, right? You got the funding of the government, I think, in mid-October as well. So there's a couple of challenges and headwinds coming up. So they might have sold those thinking that stock might actually go down. And if it goes up, that's fine. I mean, it'll just the shares will get called away, and then they'll buy them back, and then they'll end up just keeping that $327,000. All right, so the great thing about this is they're doing this for you, okay? And they're also paying you out a 5% dividend yield. Okay, now if you had a dividend portfolio full of all these stocks, you probably wouldn't even come close to a 5% yield. Microsoft, Apple pretty much pay nothing, and that's what you get out of an ETF like this. Okay, now you're probably thinking, oh, I don't trust this. I don't understand what covered calls. I don't understand options. Well, you really should learn about options. You should learn about covered calls. If you own a dividend portfolio, you should think about running some covered calls against some of your positions. It's a great way to make money, and there's really no way to lose at all. If you sell, as long as you sell your strike or set your strike above your cost basis, ideally, a little ways above your strike price, there's no way you can really lose. Now, it could obviously, run past your strike. You might miss out on some upside. That's probably, the biggest risk there, but that's not really a risk, right? You're still going to capture some upside, but you're kind of banking that it's not going to go up 5% in a matter of 30 days or something like that, okay? So a ETF like this, managed, by the way, for a relatively pretty cheap 0.55 expense ratio, you're going to get that added capital from these covered calls that they're going to do for you. You don't have to manage it at all. And also looking here at their taxes, this is just the last distribution here. So that 15 cents that they distributed out, 39% of that is going to be net in what they call estimated net investment income. But so it's NII, so net investment income, which will just get taxed at a normal rate. And then you also have 61% there as return on capital, which you're not going to get taxed at all on. So they'll issue a 1099 DIV. There'll be a certain boxes there with a certain amount in it. And 61% of that 15% per share will be not taxed, to be return on capital, so you won't pay any taxes at all until you actually sell out of your Divo. You won't get taxed at all, but you will get taxed in 39%. Now, granted, every single month it seems to be different with Divo. I think it was like last month or something like that, it was only 25% was net investment income, which means they probably just didn't have quite as much. They didn't have quite as much covered call income as they had in August, right? So, it's still tax advantage, and the way I look at it, you're not paying, it's not all qualified dividends, but not all of it's also taxable. So that's pretty tax advantage in my opinion. And then that brings us here to Seeking Alpha, which, I don't even know how accurate these numbers are. It is Seeking Alpha. We look at the dividend growth rate here, the trailing 12 months at 20%. What? So yeah, when I ran the numbers on it, and I went back, I think 5 years or something like that. I might have ran 3 years or 4 years. I can't remember when I ran. I came out to 3.5% or something like that. They're showing the 3-year at 4.6%. That's not too shabby. And that's including 2020 in there. So we have TTM here is at 20%. So what that really means is that we had a lot of dividend increases over the last 12 months or so, especially this year, right? I mean, Microsoft just had a humongous one, right? So that's pretty darn good, right? That's one of the things you're going to get out of dividend portfolio, individual stock dividend portfolio, is you're probably going to have about a 7 to 8% dividend growth rate, or CAGR, correct? That's what at least I had on mind. So with Divo, you're going to get a capital appreciation because they're going to sell the covered calls higher than what the strike is. Plus, they're not actually selling covered calls against every one of the positions in there. And not to mention, you're also going to get capital appreciation. You're going to get also dividend growth out of it, and you're going to get a 5% yield out of it. This is the best of all worlds. You really can't go wrong. It's tax advantage, you get dividend growth, you get a pretty high dividend yield out of it, and you get capital appreciation out of it. Plus, you don't even have to manage it. All you gotta do is sit back and collect some dividends. So I think that Divo is one of the best income ETFs out there, and whether you even want to call it an income ETF, I don't really know. It's in my dividend portfolio, and I may even get out of some individual positions down the road and go in more into Divo. And then, if you kind of have that with, say, SCHD or something like that, or maybe even DGRO, see the video last week, by the way, on those, then you might get a little bit more diversification as well, okay? Now, you can't sell covered calls. You could probably sell covered calls against those, but it's not going to be very easy. So Divo, in my opinion, is the ultimate income ETF out there that's very close to basically having a dividend portfolio, and you're running covered calls against it. Awesome positions, super stable, large cap companies, and they're not going to just say every single month we're going to do covered calls against every position. No, we're going to look at a chart, and we're going to kind of see how things are going, or see where things are going, and then we're going to basically base our strikes off of that opportunistically. So, anyways, if you have any comments, questions, or concerns, leave me a comment down below. Until next time, please go ahead and like, subscribe, and we'll see you next video. Thanks for watching.